Monique's asking, I'm assuming we can write off our furniture on our taxes. Do we write it off as inventory or display items? So first of all, the concept of writing it off, let me talk about that. Your company, it's really ideal for it to be set up as an LLC, even if you're a solo entrepreneur, a sole proprietor. Set that LLC up to protect yourself. And then the books, so if you're just a sole proprietor, that money is flowing in and out of your own, you've got to keep a separate account and all that. And that money that is going directly towards your own taxes, the money that's coming in and the money that you're paying out. So you're paying taxes in a different way than if you have it set up as an LLC. So, and there's no protection for you when it's not an LLC. So it's very inexpensive. It is a little bit, and it's a little bit of a hassle, but not much at all to set up your LLC. And then your business is a separate thing from you. And while that business doesn't pay tax, any of the profit from that business flows directly to you as a person. So the business, this thing that's out there separate from you, it earns income and it pays expenses. It's going to pay for that inventory. That difference in the expenses and the inventory and in expenses and income, that then comes back to you as business income, which is different from when you're a sole proprietor and it's just personal income. When it's personal income, you're paying self-employment tax on that. When it's an LLC, you're paying the company is paying half of the taxes for you. You're paying your share as an employee, and the company's, so you get paid two ways from your company. You get paid as an employee, and that part, you pay half of your employment taxes, the company pays half those employment taxes. But then you also get paid from your company with distributions as an owner of the company. And that's business income, and it's taxed differently. It's much more advantageous doing that way. Sure. And then the other important thing as an LLC is that you're being protected. If that LLC gets sued, if your business gets sued for something, they can't come after you personally and come after your house and your assets. It's just the assets of the business. So you want that protection, that separateness, but then it's also advantageous from a tax standpoint. So it's not like you're writing off that inventory on your personal taxes. It's an expense of the business. And you can immediately expense anything that is any one item that's less than $2,000. So, and you shouldn't be spending more than $2,000 on any one item anyway for staging purposes. So you immediately expense that. So you don't have to keep a spreadsheet on depreciation on that inventory or anything. You're just immediately expensing it, which is giving you shrinking your taxable income immediately that year, instead of spread out over time like you would do with an asset where you're doing depreciation on it.